It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Chinese assets finding some support on signs of life in the consumer sector. July retail sales topping forecasts, but home prices extend declines, underscoring the economy's long-term headwinds. Japanese stocks leading gains in Asia after cooler US inflation data keeps the Fed on track to cut rates next month. Plus, Tencent shares paring losses in Hong Kong after mixed earning results. Alibaba and JD.com set to report today. All right, it's modestly risk-on tone across the region. Avril Hong's in Singapore taking a look at markets. Avril.
Yeah, it's pretty risk-on, as you say, amid a very data-heavy day. I mean, already coming into today, we were digesting the U.S. core CPI after easing for yet another month and cementing pretty much this Fed rate cut come September. That was good for Wall Street, and we saw already that tailwind for the Asia-Pacific. Japanese equities already leading the way against the backdrop, of course, on that Q2 GDP print, which grew more than expected, showing private consumption giving a boost, and the signs that this virtuous cycle that the BOJ wants to see is taking hold. And of course, we got the China data that's adding to further optimism that maybe we're turning the corner on the Chinese economy. Chinese stocks are also doing pretty well. Flip the board and take a closer look at the data as the retail sales number was better than expected. Property investment contracted continuously, but we also saw the home price data and the declines actually ease. So adding to signs that maybe consumer spending and some of the sentiment is picking up there. Paul.
All right, thanks very much, Avril. Do stick around. Let's get a little bit more on that data out of China. Bring in Bloomberg economist David Chews. So, David, encouraging signs on retail sales, not so much everything else. How are we interpreting these numbers?
I think the market is a bit focusing on the retail data because it was better than expected. But we are, to be honest, we are not so optimistic on the data set, the whole data set, because we have seen the slowdown of the industrial sector and also the investments as well. And for the retail sales, we think that it was somehow boosted by the summer holiday. So we need to, and also it was still very weak growth, which was just 2.7, 2.6, which was much below the production side. So that it means the imbalance of the economy lasts.
What about the data on property investment and home prices? Does it in any way add to the sense that maybe things are bottoming out?
Well, I think based on a month's data to get a conclusion that the housing sector is bottoming out, I think it's too early to reach the conclusion. And for us, from the economy side, what we are looking at is actually the investment or the floor space, new started floor space. And these data are still pointing to the downside because we have seen the investment dropped deeper for the month. So all in all speaking, we think that the drag from the housing sector to the whole economy will persist in the foreseeable future.
Well, let's talk about some support from the policy side. You've written a column about possible MLF shifts. What are you expecting from the PBOC here?
I think the PBOC, this morning the PBOC announced that it will conduct the MF operation on August 26th after the LPR. I think this is a step that the PBOC turn to focus more on the short-term interest rate, which is the 7-day reverse repo rate. But it doesn't mean that the PBOC can, it's not a direct signal that the PBOC can cut more than expected. So we still think the PBOC can cut the rates in the 4Q, but it's unlikely to be aggressive. In the case the Fed cuts more aggressive, which means if the Fed can cut 50 bips in September, we see the chance that the PBOC can have more cut than our baseline expectation. But all in all, we don't expect anything aggressive from the PBOC. What we are looking at is the fiscal side, because the fiscal side, I think, still have more room to help the economy, because there are still slow action in spending so far in the year. So that is what we are looking at, is the fiscal side. Another reason we are looking at the fiscal side is that the infrastructure investment slowed in this month. And that used to be a key engine in the demand side, offsetting the slowdown or drop in the housing investment. But now we see it losing steam. So again, it needs more actions from the fiscal investment.
Certainly, and we also get the sense that it might be saving a bit of this fiscal firepower till after the U.S. election in November. But I just wanted to pick up on what you said about maybe we won't see aggressive easing going forward from the PBOC. But if it does cut, in what policy mechanism is it going to do this through? The reserve requirement ratios, for example?
Well, we do expect that the PBOC can cut the triple R in both this quarter and the next quarter. But again, we think it's just a way for the PBOC to provide liquidity to the banking sector. And for the interest rate, our baseline forecast is 10 bips cut in 4Q. As I said, in case the Fed cut rates by 50 in September, we see the chance that the PBOC can deliver 20 bips cut in the remainders of the year. But this is not our baseline scenario.
All right, Bloomberg economist David Chu there in Hong Kong. Still to come this hour, our exclusive conversation with the CEO of hospitality firm Ascot. We discuss their outlook for Asia, particularly in China, where they manage more than 200 properties. First, though, the Reserve Bank of New Zealand says it aims to lower its cash rate at a more measured and careful pace. Our interview with Governor Adrian Orr up next. This is Bloomberg. All right, let's take a look at how U.S. Treasuries are tracking in the Japan session following that U.S. CPI report. We're seeing yields broadly flat. The yield on the 10-year just creeping up a little, 383.90. The spread between the 10s, 2s, about 13 basis points at the moment. The CPI numbers pretty much playing ball, 2.9% on year. So nothing really here to derail this market narrative that we are looking at a potential rate cut in September. So let's get a bit more on the markets and the direction of the Fed. Charlie Jamison's joining us now, CIO of Jamison Coote Bonds, a privately owned high-grade bond manager. So, Charlie, traders now see 25 basis points reduction in September from the Fed, pretty much a done deal. A 40% chance of a 50 basis point reduction. I just wonder how much of this is priced in and what's going to happen if we don't get it, because the Fed's speakers seem to be really in no rush to cut rates.
Yeah, look, I think it'll be very predicated on the next series of employment data that we receive. Obviously, the US economy has been losing momentum in that regard. It was a very exceptional economy to start the year with wonderful data, but it's been exceptional in the second quarter and obviously over the month of July in how much that data has also slowed. And so this is where the markets have got to this place with a September rate cut to start the cycle, and they're fairly confident that there will be ongoing rate cuts. But this big debate about 25 or 50 is still hotly contested. We're about in the midpoint of that pricing currently, and there are a lot of things that can impact that. Also, this Japanese carry unwind, which obviously affected markets very brutally last week, is also potentially a consideration. So we need to factor that into the thinking of where the Fed may land.
And to your point, in terms of data, our colleagues at Bloomberg Economics have also flagged that the Fed's yardstick, the 12-month change in PCE deflator, could start showing unfavorable base effects and a pickup. Does that perhaps cloud the outlook? Because there's a lot of time between now and September, Charlie.
Look, I don't think it will. The next few monthly CPI prints that we have to drop out of the year-on-year calculation are actually quite a bit higher. There's a 0.5 and a 0.4 that come out. So in the year-on-year number in the next few months, it's very likely that CPI will come down towards that 2.5 midpoint. Now, obviously, you can get in and dissect the data and find individual elements within that are not quite behaving in the way that we would like them to. But to have Fed funds at 5.37% with inflation somewhere in the mid to upper twos looks very, very restrictive. And certainly, whilst the employment situation is cooling and a lot of the forward-leading growth data continues to show obvious decline and weakness, it's pretty evident to the markets that the Fed will embark on a rate-cutting cycle. Clearly, the scope and magnitude of that is still the source of some debate, but I think we can very comfortably pencil in, 100-ish basis points. And then the markets at the moment are pricing about 200, but that's not 100% guaranteed. That's obviously a probability that they might need to go significantly further than that 100, and it could be, 300. And so the markets will always sit with some probability in around that. Clearly, if we have more anti-risk episodes like we saw last week with that yen squeeze, and I still think that's a really big issue the markets need to deal with. There will be ongoing episodic shocks that are similar to that. Then, we may see much more action from the Fed because that would tend to be quite a deflationary period, kind of cooling from disinflation into, if we burst a few asset bubbles, then clearly inflation will follow very, very quickly.
Where do you think this will leave the two-year yield by the end of the year then?
Well, look, it's already rallied a long way, as we know, but certainly if the expectation is that the Fed are turning the supertanker of interest rates towards that cutting cycle, we certainly know from previous episodes, once they start cutting, they often continue to cut. And certainly in this episode, they've waited until the realisation of CPI has been delivered to the market. Ordinarily in the cycle, they would have adjusted policy by now, once they saw that growth starting to decay. But their data dependency that they speak to constantly, because of the lack of success with modelling the COVID period, they've really waited for this pricing data to cool off. You would normally see that anyway as growth starts to cool. So, very much like the 2008 episode, a lot of bad things happened after they started cutting. So I think the start of cuts is not, a guarantee that we're going to make it and there's a perfect bridge to the other side. There are, of course, probabilities that things don't go as smoothly as that. And so it's very difficult to call, the two-year note, looking out a long way. But certainly markets at the moment have this expectation that with much lower realised inflations and very mute inflation outcomes around the world, probably ex-Australia at the moment, then there is a pathway to significantly lower rates, which is what's being priced.
Yeah, well, that's certainly what's happening in New Zealand. I just want to get your thoughts on that move we saw from the RBNZ yesterday, Charlie. I mean, we went from the RBNZ saying in May they're not going to do anything until 2025, and then yesterday the news that they considered 50 basis point move. How's your confidence in New Zealand's central bank at the moment?
Look, the confidence is there. I mean, they have a history of making relatively large statements, and then they like to move the market, we believe. We felt that there was a good chance of 50 yesterday. We were very comfortable that 25 would be delivered. And again, the reason for that is that the inflation pathway there does start to fall very, very rapidly. In the third quarter, there is a huge number to drop out from the third quarter of 2023. So the year-on-year number is very likely to come down into the twos or very low twos. And again, with interest rates currently at 5.25, that looks extremely restrictive in an economy that is really struggling. It's had very, very limp GDP and retail sales type outcomes. It does need to have the reins let out a little bit. And certainly you'll hear from Governor Orr in a moment that that's broadly their thinking. That's what they suggested yesterday. Some of the domestic banks are actually taking it a lot further than that and suggesting that a terminal rate of 3% is highly possible. We would probably be more in that camp, that there can be quite a lot to be delivered here, assuming that inflation is becoming well behaved, as we've seen in many of the G7 economies already.
All right, Charlie Jamieson, CIO of Jamieson Coote Bonds, thanks so much for joining us. And New Zealand's central bank says it now intends to reduce rates at a measured pace after delivering that quarter percentage point cut on Wednesday. Governor Adrian Orr told us the cautious approach aims to ensure both positive economic growth and stable inflation.
We are very confident that headline CPI inflation is already within our 1 to 3% target band. Obviously, the data lags the official data, but all of our near forecasts say we're there, and that gives us great confidence that we can now start easing policy. The important things that we've been watching for have actually been around price setting behaviour, inflation expectations, and the path of the non-tradable domestic homegrown inflation components. All are now aligned with low and stable inflation being restored to New Zealand, and that's the outlook for the next couple of years. What that means is we can shift increasingly from a restraint position back to a more neutral monetary policy position. The official cash rate from 5.5 to 5.25 still remains quite restrictive. We see a neutral rate more around the 3% level. So that gives you kind of a scalar. At what pace would we want to get there? At a careful and measured pace to ensure that inflation expectations remain anchored at that 2% target rate. That is our single focus.
You mentioned the neutral rate. The OCR track from yesterday looks like it might have bottomed out actually above some of the estimates from the RBNZ for the neutral rate. Do you think if the recessionary conditions as forecast materialise, there might be a need for that to change? There might be a need for rates to push now below neutral to get the economy and growth back on track?
There are many things that are pointing in the right positive direction for economic growth. So, at this point, we see just the need to remove restraint rather than provide stimulus. There's significant investment activity that is needed in the country. There's a lot of different price pressures. So, at the moment, subject to no future shocks, which is always the assumption you make in a forecast, we think we are in a comfortable control position to remove the stimulus and let sustainable growth take place.
That's RBNZ Governor Adrian Orr speaking with the Asia Trade anchors Heidi Stroud-Watts and Sherry Ann. Plenty more to come. This is Bloomberg. Let's take a look at Tencent shares. They've been moving around a bit in Hong Kong as investors assess a somewhat mixed earnings report, off by about 1% at the moment. We're waiting numbers now from Alibaba and JD.com for more analysis now. Let's bring in Bloomberg Intelligence Senior Analyst Robert Lee. So, Robert, mixed bag here. We had a profit that beat estimates, but no extension of the buyback. What's going on? Why are the markets not convinced by these numbers from Tencent?
Well, I would say, and someone who has a natural streak of cynicism and scepticism within them, being British, that the numbers were good. There was across-the-board strength, with maybe the exception of fintech. Fintech is a business which is more economically sensitive. We saw some weakness come through on the fintech side last quarter. We anticipated that on the top line, and that's what happened. However, a mix shift actually enabled the margins to come in on the upside on the fintech business. So, as you said in your prelude, the net profit line numbers were about 18% ahead. Yes, we didn't see a share buyback this time. I think the company is poised and ready, given a very healthy balance sheet and cash generation, to do that and to step in if we do see a prolonged period of weakness. But I think the reaction we've seen overall today really reflects the current risk appetite in the market, the risk appetite for Chinese shares, and sort of reflects what's been going on in the States and other markets over the last couple of weeks. So these were great numbers. The market did expect that. They came in a bit better, but was it enough to promote gains? Well, based on the initial market reaction, not today, but we'll see over the coming days.
Okay, since it's really good results, as you say, Robert, then give us a sense of the extent in which you think Tencent would continue perhaps faring better versus some of the other Chinese tech names, the e-commerce heavy ones.
Yeah, I think, compare and contrast a company like Tencent versus Alibaba. Alibaba's had multiple challenges, strategic and also market structural-driven challenges, as well as cyclical ones. Obviously, the Chinese consumer is very weak, and we're seeing a structural shift in the e-commerce market, whereas the low-cost disruptors like the Temus and Sheins have been rapidly gaining share. So no wonder the likes of PDD, as a stock, has done so well, over the last 18 months or so. So there are multiple challenges for Alibaba to overcome. And also, secondly, on Alibaba, they eye two main markets for growth, cloud computing and also AI. And we've got price wars in both those sectors at the moment, with levels of competition being, rampant, I would say. So it's quite a challenge for them to drive new earnings growth from those two growth sectors. Whereas, compare and contrast with Tencent, it's a much more defensively positioned business with high barriers to entry on the technology side and otherwise. So it's more defensively positioned. Yes, of course, it's still exposed to some macro risks, but the risks to them on the macro front are lower, I would argue, than a company like Alibaba, and they're successfully navigating those at the moment, and as I said, beating numbers at the bottom line by about 18% on the quarter. So the strong momentum in Tencent's business at the moment, the earnings strength should continue at least through the rest of this year. Yes, they will enter a period of slower growth, more normalised growth, though, into next year, and maybe the macro headwinds will become more of an issue for investors.
Robert, just quickly, JD.com also due later. What are you watching out for there?
I think compare again and contrast with Alibaba. It's executed more consistently than Alibaba. The strategic issues that have affected Alibaba are less relevant, and also, it's more of a core e-commerce e-commerce business. The market is looking for a decent uplift in profit, although the top line growth will be relatively flat. So I think, relative to some of its peers, the sort of view on JD.com is more steady as she goes, I would say.
All right, Bloomberg Intelligence senior analyst Robert Lee. And it's a busy time for earnings. Let's take a look at some of the other names that have been reporting. Hon Hai dropping. This is despite second quarter beat amid margin concerns. We've also got Samsonite shares falling as well. Profit hurt there by China's sales. The US listing, meanwhile, pushing as a prolonged China drag as well. And if we take a look at New Farm shares, well, completing the trifecta, that also falling after downgrading earnings guidance. They were off more than 12% at one point after cutting the full year forecast. Still to come, hospitality firm Ascot says it is working towards doubling its fee revenue by 2028. Their CEO joins us for an exclusive interview next. This is Bloomberg. Welcome back. We've got markets in China just heading to lunch. Pretty positive day for markets there. We've got the CSI 300 better by more than 1%. That was notwithstanding some pretty wretched data that we got out of China earlier. Industrial production numbers 5.1%. That was a miss, and a further decline or contraction from the 5.3% we saw in June. New home sales also contracting sharply in July. Retail sales, they were a bright spot, up 2.7% on year, and that was a beat. But China's steel prices also the lowest since 2014, and iron ore prices slumping as well. Well, our next guest runs hospitality firm Ascot, which has more than 950 properties globally. About a fifth of those are in China. It's also a business unit of a global real estate manager, Capital Land Investment. Joining us exclusively now, Ascot CEO Kevin Goh. Kevin, thank you so much for joining us today. I just want to start off, if I can, with the broader picture in China, because you've got a unique perspective on China's macroeconomic health. You have a lot of properties in their manufacturing hubs. I'm just wondering what sort of impact you've seen this slowdown having on demand for your business.
Thank you, Paul, and thanks for having me. Before I answer that question, which I think we're all very concerned about, it'd be helpful for me to first set the context of what Ascot does and our business model in general. So we are a global leading service apartment operator. We have close to about 1,000 properties across 230 cities, 44 countries, and we operate around 14 brands. We have global brands and we have regional brands. So global brands are deployed globally in London, in Paris, Singapore, Sydney, and regional brands are more dominant in local geographies. For instance, the Quest brand in Australia, New Zealand is quite dominant with about 200 properties across both countries. Now, from a business model perspective, we're a little bit different from traditional hotels in that we operate both on the long stay and short stay spectrum. So we can take stays of up to a night, and we can also take stays for the longer term. I mean, the longest guest we have on record is over 20 years with us. The unique point about this business model is that we can pivot depending on economic conditions. When times are good, we'll lean into more short stays to yield higher room rates. When times are bad, we can back off a little bit and do a little bit more long stays. We have a very asset-light business model.
Kevin, sorry to interrupt. Thanks for the overview on the business. Just wondering on the China issue. I mean, even the CEO has said and acknowledged COO, I should say, has acknowledged some of this investor impatience about the pivot away from China. What is that going to mean for the divestments? Is that going to mean that you have to take steep discounts on the assets?
Thank you for that. And that was the next point that I'm coming to. We operate a very asset-light model. So 95% of the properties that we have globally are actually on a franchise contract or a management contract, right? And today, China takes up roughly about 15% of our revenue contribution from a lodging perspective. So especially when we know it's going to be a rough ride going ahead, we are leaning more into the long stay model. So a lot of owners actually like us because we lean into the long stay model. We have better predictability in terms of income. The income profile is more stable. And for us in China, actually from a first quarter perspective, we have actually a 5% increase in RevPAR, which is the revenue per available room. And for the first half, we are roughly about flat. So because of our resilience in our business model, we've been able to weather this pretty well. And also because we are on a asset-like business model, the property values actually don't affect us as much.
What are you seeing on the ground in China with some of your properties close to these manufacturing hubs? Are you seeing the impact from the slowing economy? Yeah,
so we generally, like I said, pivot more into the long stays, and we still see very robust corporate demand, especially in the Greater Bay Area, southern China. I think things are still humming along fine. As what I just mentioned, revenue per available room wasn't affected as much. We still get a kind of flattish number first half this year compared to first half last year. Yeah.
How about acquisitions in China? Would you be ruling those out in the near future?
So because we are on an asset-light model, we will be acquiring more management contracts and franchise contracts. So that model actually requires very little equity from us. If we work with owners who owns the buildings, put our brands on the building, give us a fee to operate the building, we are quite insulated to the real estate value and fluctuations in China.
Let's talk about the lodging front as well, because China travel demand, particularly outbound, has been somewhat sluggish. How's that informing your strategy at the moment?
Well, in terms of growth, we've been actually enjoying quite good growth momentum. We started in 2008 with about 20,000 keys, roughly, and we've been doubling that inventory every 5 years. By 2023, we're at 160,000 keys, and that's about 8 times in terms of growth. We are looking at growth through many different vehicles. I think we have growth through M&A. We did an acquisition of a brand called Oakwood just about a year and a half ago. We've grown it 20% since. We've acquired brands like Synergy, Quest in Australia, New Zealand, and a platform in Indonesia. In terms of outbound travel from China, I would say it's not as strong as before, but we do see spurts. Just for example, the summer holidays, right, that just passed in July, we actually experienced very good occupancies in Singapore. I mean, most of our properties are running above 90%, and we also observed that a significant proportion of those guests are actually from China. So China being a very big place, there are still a segment of customers that travel regularly and stay with us overseas.
What about in terms of other EMs such as India? Are you potentially considering future acquisitions and expansion there potentially?
Yeah, so any acquisitions for us would be on the asset-light side. So we'll be buying platforms, we'll be buying brands, and we'll be on the lookout to scale up on that front. The emerging markets have actually done very well for us, and we've got close to 200 properties in Indonesia, with another 200 in Southeast Asia, Singapore. So the rest of the Southeast Asia countries like Philippines, Vietnam, Thailand has actually been stepping up quite nicely for us to fill the gaps where other parts of our portfolio are weaker.
What about Europe? I mean, there's so much focus on France in the past month or so. There was a bit of a mixed impact, I think, from the Olympics. What do you see there in terms of the market? Yeah,
Europe is exciting for us. We just signed close to 1,000 keys in Europe, mainly in the UK and in France. We are actually very excited with the growth in Europe because it's a market with high ADR, and the places that we are in, for example, Paris is one of the most visited cities in the world, and we've got about 20 properties in Paris. So that worked very well for us, even though we read reports that demand for travel is a little bit underwhelming during the Olympics, but we actually benefited because we took in groups like yourself. I think we have journalist groups covering the Olympics, and they stayed 2 months, 3 months with us, and that actually buffered a lot of the impact that you read on the papers. And of course, one more thing to add is our partnership. Yep. Go ahead, Paul.
I just wanted to talk about Japan as well while we have time. We have a situation where the path of least resistance for the yen is probably higher. Rates are going higher as well. Lodging space is fairly crowded. It's pushing up valuations. What's your strategy for Japan at the moment?
Japan is an excellent market for us. It's been the top performer for us. We've got over 20 properties in Japan, and they're all doing exceedingly well. Even you talk about the strengthening of the yen. If you compare it to, say, 2 years ago, it is still at a fairly attractive levels. So even though it has strengthened a little bit over the last few months, it is still a very attractive market. We still continue to see very strong bookings for our Japan properties, and we'll continue to do more in Japan.
We're seeing the lodging space in Japan getting a bit more crowded, though. Is that affecting valuations and potentially the competitiveness?
Not that I observe, because we do see valuations actually going up, and interest rates have stayed relatively benign, even though there was a slight rise earlier part of the year. But I do see valuations holding up. I do see demand holding up, and I do see continued tourism demand for Japan.
All right, Kevin Goh, CEO of Ascot. Well, let's take a closer look at markets in Japan. Avril, what are you seeing at the moment?
Yeah, I mean, we've been really digesting that data out of Japan today, where we saw a faster than expected growth, that pickup from the first quarter contraction. Second quarter growth coming in quite healthy, and this was driven by private consumption. This is part of this virtuous cycle that the Bank of Japan wants to see, right? Higher incomes pushing up spending. So this is a tailwind for the central bank. But if you flip the board and take a look at what we're seeing across assets, it doesn't seem like that hawkish reaction function to the data today. Of course, we did get some of these, digestion of the U.S. core CPI print coming in line with expectations, cementing what we're going to get from September out of the Federal Reserve. 25 basis points certainly baked in here, and Japanese equities are the ones that outperform. But in terms of the yen, it sits pretty flat against the greenback. Still, a couple of reasons for this. We, of course, have the BOJ Governor Ueda going into next week. He'll have to face the heat in Parliament from politicians over the rate hike last month and how that is being blamed for fueling the onslaught in Japanese equities. So to the likes of our M-Life strategist, Mark Cranfield, he thinks that this could push him to, come through with a bit of more dovish tone to appease politicians. And then don't forget the political uncertainty, of course, in Japan, against the backdrop of what we heard from Kishida just a day ago. Paul.
All right, thanks, Avril. Well, that GDP data coming as Japan now awaits a replacement for Prime Minister Fumio Kishida, with no clear front-runner in the party.
Kishida actually wanted much stronger reforms, and his party colleagues blocked them. And so I think the public looked at this as an empty gesture, whitewashing, and nothing will change. And this public skepticism has translated into ebbing support for the LDP. So I don't think that leadership change is going to really restore public trust. I think that has really descended into a deep hole, and I'm not sure there's any leader of the LDP that can help it climb out of that.
Well, Bloomberg opinion columnist Garode Reddy says this may open the door to a chaotic era for Japan. Garode joins us now from Tokyo. Garode, tell us more about your take on Kishida's decision.
Yeah, it certainly came as a surprise. I think the expectations had been rising in Tokyo in recent weeks that Kishida would not only run in next month's race for LDP leader, but that he would win pretty much by default. But I think what has happened in recent weeks is similar to what happened, I think, in the U.S. with President Biden, that it became clear that the next election, it's not imminent here in Japan, but it does need to be held by October of next year, and the LDP would obviously prefer to hold it at a time of their choosing. So I think it became clear that Kishida was not going to be able to lead the party into an election and come away with the type of win that the LDP is used to winning. I think we'll find in recent weeks that probably someone has had a conversation with Prime Minister Kishida and made this polling data very clear to him and said it's time to draw a line under this era of the LDP and move on into a new one.
Logically, though, Kishida should have been able to kind of take this victory lap on defeating deflation. Why do you think, among other things, he's not been able to connect with the public?
I mean, for one thing, I think Japanese prime ministers in general tend to struggle with sort of public support after about 2 years. It really doesn't matter who they are, with some very unusual exceptions, such as the late Shinzo Abe. Generally, the public just kind of gets bored because of the nature of politics in the country. I also think Prime Minister Kishida could have done a better job, as you say, in terms of hyping up some of his achievements that that he somewhat failed to do. He could have declared the end of deflation. He could have made a bigger deal about taking the country out of COVID. He could have celebrated, the stock, records that we saw earlier this year. But he had a tendency to sort of take ownership of things that were not necessarily his fault. It's an admirable trait in some ways, such as the Unification Church scandal, such as the funding scandal that ultimately he took responsibility for in his resignation speech yesterday. Well, not his resignation speech, but his speech announcing that he would effectively resign. Instead, he took responsibility for things that were not his fault and failed to triumph his own accomplishments.
What's the mood like on the ground in Tokyo at the moment, and how willing would a new candidate be to get a fresh mandate in a snap election?
In terms, just to answer your second question first, I think it's very likely that a new candidate will call a snap election. Kishida did this to great effect when he came into power 3 years ago. His predecessor, Yoshihide Suga, failed to do that. He had an opportunity to do that when he took over in late 2020, and he failed to do that, which I think is widely seen as a mistake that would have given him a mandate that, that could have extended his term. So I think it is quite likely that will happen regardless of who wins. Otherwise, there aren't a lot of other opportunities for the LDP to call an election, as I say, at the moment of their choosing. Just the parliamentary schedule and other events just become too packed. In terms of what the mood is in Tokyo, I would say it's somewhat confusing, I would say, but also somewhat hopeful. In terms of the general public, there was a sort of, as I say, an ennui or a boredom with Kishida's reign in power, which had gone on for 3 years, which is a fairly lengthy amount of time for a Japanese prime minister. But I don't think anyone is at this stage expecting an entirely new LDP or someone to swoop in. Having said that, it's often at these times that you see, a candidate that maybe we didn't expect might come in and take over and might actually connect with the public in a way that we previously hadn't expected, and that might give a bit of a boost to politics in this country.
All right, Bloomberg opinion columnist covering Japan and Korea, Garode Ridi there. Still to come, a court removes Thailand's prime minister from office as the royalist establishment reasserts its grip on power. We'll have an update from Bangkok next. This is Bloomberg. Welcome back. You're watching Bloomberg Markets Asia. India's on holiday today. We are, of course, monitoring Prime Minister Narendra Modi's Independence Day address in New Delhi. The theme is Viksit Bharat, translates to developed in India. There he is after wrapping up his comments today. He has a vision to transform India into a developed nation by 2047, which will be the 100th anniversary of independence from Britain. A few remarks that he made. Violence against women needs to be addressed quickly, and India remains committed to reforms to strengthen the nation. So Indian Prime Minister Narendra Modi wrapping up his Independence Day remarks there at the Red Fort. There he is speaking a little bit earlier. Well, let's move on to Thailand. The Constitutional Court there, of course, dismissing Prime Minister Srettha Thavisin from office after finding him guilty of an ethics violation. A multi-party coalition led by the Thaksin Shinawatra-backed Pheu Thai will meet and choose a prime ministerial candidate later on today. Now, Bangkok reporter Papicha Tanaka-Stempenpat joins us now. So, Papicha, what's the latest?
Yes, Paul, now that SETA's out, we are entering a new period of political uncertainty. But the good news is that things seem to be moving quite quickly because the House of Representatives is already scheduled to meet on Friday mornings to pick the country's new prime minister. Now, to recap, there are 6 candidates who are eligible to become Thailand's new prime minister, and it is expected that SETA's Pheu Thai party will try to retain the premiership with the party. And that's why the party needs to really really focus its efforts today on bringing the coalition partners to the negotiating table to try to ensure that they can win the prime ministerial vote in one go tomorrow in order to form a new government as soon as possible.
Oh, it looks like a Thaksin loyalist is emerging as the front runner. What are you seeing in terms of, the odds and who might be next?
Sure, April. Pheu Thai is having a meeting later today with its coalition partners, and it is expected that they will confirm the nomination of a longtime ally of former Prime Minister Thaksin Shinawatra, the 75-year-old former Attorney General Saikasem Nitisiri. Otherwise, the Pheu Thai party still has another eligible Prime Minister candidate, that is Thaksin's own daughter, Paetongtarn Shinawatra, who is the leader of Pheu Thai party. But now we will be watching very closely today for any signs of challenges that the coalition parties might be bringing to Pheu Thai's nomination plan, because if that happens, then we need to watch out for another prime ministerial candidate, that is Anutin Chanvirakul, who is the leader of Phum Chai Thai party, that is now the second largest party in the coalition.
Well, what's the impact of this upheaval having on the economy, the markets, and the broader business environment?
There is a great sense of anxiety actually in Thailand at the moment, because in just 2 weeks we have seen 2 political earthquakes at the hands of the pro-establishment Constitutional Court. Last week, the Thai public was quite upset already with the court's decision to disband the largest opposition party, Move Forward Party, and now we have lost a prime minister in less than 12 months. Now the big question on anyone's mind is on policy continuity, because it is very uncertain at this stage if SETA's flagship $14 billion cash handout program will go ahead after the change in leadership. And investor confidence is also set to be further damaged by implications of political instability, because so far foreign funds have already pulled more than $3 billion out of local markets this year.
All right, Bangkok reporter Papicha Tanaka-Semperpat there. Here are some more top geopolitical stories that we're following. Russia says it has repelled a wave of Ukrainian drones and missiles in one of the largest overnight attacks of the war. Moscow says 117 drones were shot down over almost all border regions, as well as a region east of the capital. Ukraine says its forces continue to advance into Russian territory as Moscow rushes reinforcements to the Kursk border region, where Ukraine says it has seized control of more than 70 towns and villages. A new Quinnipiac University poll suggests Democratic presidential nominee Kamala Harris is leading her Republican opponent Donald Trump in the swing state of Pennsylvania. The survey gives Harris 48% support to 45% for Trump, with 4% backing Robert F. Kennedy Jr. Harris is set to formally accept the nomination next week at the Democratic National Convention in Chicago. Plenty more to come. This is Bloomberg.